Going into early June 2026, global markets faced a severe macro tension. May's inflation data looked incredibly hot on the surface, reaching a 3-year high of 4.2%. But that top-line number was masking the actual economic reality. Top-line inflation spikes to 4.2% on the left, but core CPI remains completely flat at 2.9%. This divergence is highly localized. Energy price spikes in May generated over 80% of the entire top-line increase. This specific data profile trapped the Federal Reserve. A resilient labor market and high nominal inflation pressured officials to maintain hawkish interest rates. Yet the core data proved that core services showed no secondary inflation threat. If the Fed tightened monetary policy based entirely on a temporary supply-side energy shock, they risked crushing domestic credit conditions and compressing the broader economy for no structural reason. Global capital was effectively paralyzed. Portfolios were locked inside an energy-driven cycle, waiting for rate hikes. It required a massive geopolitical event to provide a path forward. That event arrived early in the week. The US and Iran entered high-level, closed-door peace talks. The prospect of a finalized agreement provided the exact external intervention the market needed to reintroduce dormant liquidity. The physical energy markets reacted immediately. Traders rapidly priced out the $10 to $15 war premium that had been tightly baked into crude oil contracts for months. Long positions liquidated en masse. WTI crude plummeted to $85.12 a barrel, hitting a strict 3-month low. As crude crashed, inflation fears evaporated, dragging the 10-year Treasury yield down from 4.55% to 4.45%. This drop triggered a violent capital rotation. Institutional funds drained defensive positions in energy and gold, rapidly chasing high-duration growth assets. The sudden decompression in bond yields provided the crucial financial oxygen required to ignite the largest tech IPO in Wall Street history. On June 12th, SpaceX executed a flat-priced public offering at $135 a share. That fixed pricing structure locked in an initial market valuation of $1.8 trillion. The valuation itself is secondary to the true Wall Street mechanism at play here. This IPO sparked a fierce high-stakes battle over passive index inclusion rules between the S&P 500 and the NASDAQ 100. The S&P 500 Index Committee took a hard line. They explicitly refused to grant SpaceX rule exemptions regarding strict GAAP profitability or public trading duration. This table maps the criteria. SpaceX's $4.9 billion net loss in 2025, driven by heavy infrastructure expenditures, hits a hard barrier under S&P rules. But NASDAQ rewrote their methodology, adding a fast-track bypass allowing top 40 market cap companies index inclusion within 15 days. By bending their regulatory framework to accommodate Musk, NASDAQ effectively committed trillions of dollars in passive funds to an asset that had never faced a public trade. The flaw in this structure comes down to the concept of free float, the actual number of shares available to trade on the open market. Because Musk heavily restricts internal equity and prefers strict control, only 3 to 5% of total SpaceX shares were actually offered to the public. Let's look at the hard math. At 3 to 5% float means there is only $52 billion to $88 billion of actual tradable SpaceX stock in existence. NASDAQ's algorithm inflates SpaceX's weight to a 15% cap across its $1.4 trillion in passive tracking funds. This creates a mechanical collision. By July 7th, funds are mathematically required to buy $210 billion of SpaceX stock, but only $88 billion is available. We saw the mechanics of this in December 2020, when passive funds were forced to buy Tesla at highly elevated prices upon its S&P inclusion. The SpaceX float distortion makes this incoming squeeze significantly more severe. This guaranteed mechanical demand is forcing active capital to front-run the squeeze, creating an algorithmic trap for the passive funds that will follow in July. While retail investors chase these public market liquidity squeezes, private capital is actively moving away from virtual software layers. They are adopting a strict new framework known as HALO, Hard Assets, Low Obsolescence. You can see this in the $12 billion Series B funding for Prometheus. Silicon Valley heavyweights are moving past pure large language models, placing massive bets on atomic-level physical engineering AI. But the ultimate expression of the HALO strategy materialized this week via a $10 billion joint venture between KKR, NVIDIA, and Vistra. This flowchart maps out the joint venture's operating structure. It combines KKR's private credit, NVIDIA's priority chip allocation, and Vistra's 20-year on-site nuclear baseload power, converting volatile tech and energy inputs into a stable, bond-like cash flow. By racking hardware in long-term power contracts, this financial engineering turns data centers into a low-risk inflation hedge built specifically for sovereign wealth funds. The competition for AI dominance now centers on heady industry assets like power grids and physical infrastructure, rather than just software code. This rotation toward physical assets forces multi-strategy funds into a difficult position. They need a beta hedge to protect their portfolios from an overbought U.S. tech sector. This chart directly compares the forward PE multiples. The S&P 500 trades at 22.4 times forward earnings. By contrast, the Nasdaq Golden Dragon China Index sits at just 11.9 times. Managers are utilizing these Chinese platforms because they represent deep value. Furthermore, these ADRs command the exact physical moats and manufacturing capacity that global capital is currently prioritizing. For example, companies like ASE Semiconductor are securing the massive advanced packaging orders, specifically CoWoS technology, physically required to build out the AI hardware boom. When the SpaceX IPO temporarily sucked liquidity out of U.S. markets and pressured heavyweights like Alibaba, the broader HXC index held a rigid structural floor at the 6,200 level. The hedge performed exactly as intended. The focus of institutional capital has moved away from speculative trades based on rate cut fantasies. In this new environment, survival depends entirely on physical moats, value multiples, and the certainty of free cash flow.